without further ado, I'm just going to kind of let you know a little bit about what we're going to go over today. Today, you're on a meeting to find out what's going on with the market today, right? We're going to talk about the big industry changes. I know there's a lot of questions, a lot of concern going on with how our lenders approving borrowers in this situation and all the people that are affected with the COVID-19 pandemic that's going on right now. We do have answers. We have a lot of great solutions. We're going to be talking about Fannie Mae, Freddie Mac, and Ginnie Mae. What Ginnie Mae is the pool of investors that do government loans. So we're going to get their stance on employment, on appraisals, how they issue that, and that sort of stuff. Again, make sure you're putting your name. And so people that are just joining us, I'll be repeating this a couple times because we will be having people coming in, scattering in. As long as you have 50 minutes of content, you can get your 1 hour certificate. But we will need you to put your name, your full name, not just your first name or just your last name, full name, your license number if you have it, and a valid email address in the chat button, and make sure you do that. So I'm going to go ahead and start with our presentation. I hate to make people waiting with a bunch of rhetoric, but again, I'm Perry Henderson. I'm the Director of Education Center. And I've been in the industry since 1993. We've seen a lot going on. We've seen the ups and downs. We've survived 2008, right? So we can get through this together as one united community, and I'm really excited. So Brad Dollar, he's amazing. He's been with us. He started with Directors in 2019, and he's decades and decades of mortgage industry background as well for him. And he's a loan originator. He's also a DE, which is a desktop delegated type underwriter. So he knows the ins and outs, which is great when we're out there talking with you guys, that we have somebody that's a great resource for us to find out about deals that might be a little bit more challenging. And Brad's just been an amazing addition. I'm so honored to tap into his knowledge and have him present today. So Brad, without further ado, would you like to take it away, sir?
Sure, thank you very much. Glad to be here, and hopefully sound's coming through fine. It's all good. So yeah, my background is in both on the ops and sales side. I've done both. And, one of my big roles here at Directors is to make sure that, as new information arrives, that it's disseminated to everyone and that everyone understands what we can and can't do. And it's never been more important than right now. Right now, things are changing very quickly, and it's a very unique time for all of us. And, what's very interesting is, the mortgage world is so complex that, it kind of goes in steps. So first, we're reliant on the programs to kind of put out their direction on what we can and can't do. And then as a result, we then have to take that information and find out all of the parties that are involved in a mortgage transaction, their take on everything. So whether it be warehouse banks, investors, mortgage insurance companies, all of those parties that are involved in a transaction have to sort of weigh the risks and their own internal analysis of what's going on. And that sort of, all of that information then comes back to lenders like Directors, and we have to take all of that and sort of determine what we can and can't do based on that. Now, what's so great about working at a company like Directors is we've been around for over 20 years, and we have so many relationships with various investors, warehouse banks, MI companies, all of that, that it allows us to sort of pick and choose on each individual loan what is the best way to go about doing that to really afford us the abilities to take full advantage of the guidance that's come about. Every loan is a little different, and having multiple ways to do that really allows us that flexibility. The plan today is to go over all of these updates, provide detail on them, and of course, if you do have questions, please put them into the chat, and Perry will jump in and ask it, and I'll answer it right then and there. I'd rather address it while it's top of mind. We're not going to do the kind of wait to the end thing, although we will have time at the end for anything else that you guys want to discuss, but do feel free to jump in if you have a question as we go. All right, so we're going to start this with Fannie and Freddie, so conventional lending. They were the first ones to sort of put out guidance on this, and that's kind of our jumping off point. as it says on this slide, they're trying to address questions and concerns that industry partners have raised. They're working under the guidance of FHFA, which is the Federal Housing Finance Agency, to offer temporary measures to help ensure lenders have, the clarity and flexibility to continue to lend in a prudent, responsible manner. And, it really kind of goes both directions on this. There are certain areas where they're affording us more flexibility to account for the uniqueness of the industry, but then there are other areas that pose additional risk where we have to actually have guidance that's a little more strict than it used to be in order to account for that risk. And that is sort of what Fannie and Freddie have put out there, and we'll go over all of that. So the first is the age of documentation. Prior to all of this going down, everything from income, assets, appraisals, credit needed to be within 120 days. Couldn't be more than 120 days old at closing. Because things are changing so quickly for our borrowers with regards to their employment and those sorts of things, they've actually tightened up the guidance on the income and asset portion of this. So nothing has changed for credit and appraisal timing, but for income and assets, they cannot be more than 60 days old at the time of closing now. So they've cut that time in half, again, to make sure that any recent impact on borrowers is accounted for. And that we understand fully what risks are associated with a file before closing that loan. Additionally, verification of self-employment. That timeline close to funding has decreased as well. We now need to, within 10 days of closing, re-verify that self-employed businesses are open and functioning. And that's really it's really a lot of sort of one-off case by case on that, because there are many different types of self-employment, and many are obviously not impacted by what's going on right now. Others are very much so impacted. And so it's kind of a general guideline, and we have to, as a lender, address those case by case based on the nature of the business. If it is a business that typically does have customers that are coming in for them to function, that's definitely one we are going to have to be more strict on than one that is a remote type business that probably is not as impacted. What that verification means is that, let's take an example. Let's say it's a, local eatery, that involves calling the business number and seeing, are they open for business? What happens when we call that number? Is it still functioning? And, if it's not, then we need to, dig more deeply to find out, what's going on. Has it been impacted? Are they temporarily closed? And based on that will dictate our ability to proceed. If a self-employed business is currently temporarily closed, that is going to be an issue for lending right now. They need to be open and operational for us to lend, or we will have to wait until they're back open again. Market-based assets. This is kind of referred back to, yes.
Actually, before we do that, I'm going to mention to everybody another time to make sure in the chat button that you're putting your name and or your license number if you have it, and an email address, because I want to make sure we have a lot of people on, but not that many people that have put their information in the chat. And if it's not there, then you don't get your 1 hour Oregon CE credit. So anyway, I just want to start. And then we were talking about self-employed borrowers, and
Yes.
What if what if they haven't filed their 2019 taxes yet? Because now we have the extension to July.
Yeah.
They're required to. How are we addressing that?
That's a great question, and we will cover transcripts fully, but this is a good thing to bring up. So typically, prior to all of these temporary changes, if a borrower had not filed taxes yet, we'd get proof of extension, and we'd use the prior tax returns. And depending on the program, that'd be 1 or 2 years. So it'd either be 17 and 18 taxes or just 18 taxes. And then we would also have to get tax transcripts on those prior years. Now, what's changed and allowed some flexibilities in one sense and less flexibilities in another is obviously there's no extension that needs to be filed right now, because everyone's been extended. So there's no copy of that we need. We still are going to base income on the prior years. However, at this time, we don't have to get the tax transcripts because we're not able to obtain them. The IRS is not providing them right now. We are asking, borrowers do have the ability to go in themselves and obtain tax transcripts from the IRS website. Most of the time that is working. That allows us to at least see them and make sure they match up with the tax returns. We do attempt to do that to make sure that we're using the figures that match. But we can, if for some reason that's not working or we can't obtain them, that's not going to prevent us from being able to move forward with that borrower. Now, on the flip side, where it's gotten a little more strict is typically, unless there was something raising a red flag or concern, we would just go off the prior tax returns and the proof of extension, and we wouldn't necessarily need a profit and loss statement unless there's a specific reason for it. That, because of the turmoil of what's going on and the potential impact on businesses, has become more important in making sure that we're making a prudent underwriting decision and that any difficulties are accounted for. So something we are seeing a lot more of is the need for those profit and loss statements. Now, those are not CPA prepared, audited P&Ls type stuff where a borrower's paying a bunch of money. They can be borrower created or CPA unaudited created, which is cheaper, faster, but it's still an ability for us as a lender to be able to see what's going on with the business. So depending on the nature of the business, the nature of the income, how long the business has been there, a lot of other factors are going to dictate whether that's needed or not, but that is something that is popping up more often than it was prior to this. So does that make sense? Cool. All right, market-based assets. So this is reverted back to kind of the way it used to be for those of us that have been around here a few years. We remember when we could only use 70% of stocks, bonds, mutual funds, that sort of thing. That got more flexible. We were able to start using 100% for borrowers. And right now, as a result of all of the market fluctuations and the ups and downs going on, that has went back to the 70% figure that we can use when we're attributing for things like reserves. If they're using market-based assets for down payment, they're pulling out those funds anyhow, so we're going to use the amount of funds that they pull out. But when we're talking about untouched assets for determining how much reserves and money a borrower has available to them, we're going to use 70% on that. It's no longer 100%. And again, that's temporary during all of this. Okay, powers of attorney. This one is... I'm going to do my best to explain it. Neither Fannie or Freddie did a super job in explaining it. It can get a little bit convoluted, but I'm going to do my best to try and bring it down to sort of the Cliff Notes version. So powers of attorney are obviously used when a borrower is unable to sign themselves. Typically it's at closing. Most often we see it when somebody is maybe deployed or maybe they're away for a long period of time. I see it on long haul truck drivers, for example, and we have somebody else sign on their behalf, typically a spouse or another family member. What Fannie and Freddie have done is they've allowed some more flexibilities around power of attorney because of the inability for a large number of people to actually come in and physically sign, whether they be of a high-risk class where they really need to protect themselves from the potential of this COVID, or maybe they have some illness of it, whatever. There's a lot of reasons on that. But what Fannie and Freddie have allowed is the flexibility of an escrow agent to provide some of those power of attorney services and basically sign for the borrower as the power of attorney, but then they must document that they have electronically went over all of the details of the transaction with the borrower. So that means they have to document that they've done a video conference call or some other means where they've gone over all the paperwork, not sitting in front of the borrower, and as a result, they're now signing on behalf of the borrower, but the borrower has accepted all of the terms. This isn't something we're seeing a lot yet. Most of the escrow companies have been able to work this out and get actual signings in place.